how to select a stock that can 10x your returns. These are 4 things I teach my clients and students to look at when choosing stocks for their investment portfolios. In this video, I'm going to show you 4 financial measures you can use to evaluate whether a particular stock is a good company to invest in and whether it's a good price to pay right now for that investment. So if you're looking to invest in individual stocks, this video is for you. In fact, to complement this video, I'm going to give you a cheat sheet called Winning Stocks, Winning Qualities. This video talks about the quantitative metrics, but this cheat sheet I got for you focuses on the qualitative things. You need both when it comes to evaluating companies. So if you want this, comment Winning Stocks and I will hook you up with this cheat sheet. My name is Michelle Hong. I'm an author of 2 investing books, The Sassy Investor and Investing for Teens, How to Save, Invest, and Grow Money. I'm a financial educator and a fee-only financial planner, helping people build their $1 million investment portfolio in the stock market. One of the things that help my clients and students build their portfolio faster is investing in good quality individual stocks. And this video is going to show you one part of the stock evaluation process, and that is breaking down the numbers you should be paying attention to that will help you evaluate a company before investing in it. So the first financial measure to look at is revenue growth. That's right. A key indication of a company that will continue to grow is, well, you guessed it, revenue growth. How would a company grow their revenues? Well, you look at things like their ability to raise prices, how they gain more customers. Of course, declining revenues are no good. So if that's happening, well, you can pretty much stop your research right there. Or if you're just interested and curious, you can dig a little bit deeper into why that is the case. So ideally, you want to see a history of revenue growth the last 5 years of at least 10% year over year. The second thing is looking at the financial health of a company. A sign of a healthy company is how much debt it has. Like personal finances, 0 debt is the most ideal because, well, we don't like to owe money to people. But just because a company has debt, it doesn't mean they're struggling. Companies take on debt for a variety of reasons, so it's not all bad. What you want to focus on is, are their debt levels decreasing? If you see their debt balances decreasing over time, that is a good sign. So for companies that have debt, you want to look at decreasing debt levels. If they don't have debt, excellent. You don't have to assess their debt levels. The third financial measure is their gross margins. Now, gross margins will differ depending on the industry. So it's ideal to compare the gross margins of one company to their competitors and peers in the same industry. Gross profit is the difference between the gross revenue and the direct costs of generating that product or service. So gross margins is the gross profit as a percentage of the gross revenues. In other words, what percentage is left of my profits after accounting for the direct cost of creating that product or service the company sells to their customers. The higher, the better. And this is an important metric because if gross margins are really thin, it doesn't leave room for other costs to run a company, such as selling, advertising, marketing costs, payroll of employees at corporate, rent. Those are the indirect costs of a company. And if there's no room to pay for these things, well, ultimately the company is just not going to be profitable. Having high gross margins particularly also is a reflection of how strong a company's brand is. That means, are people willing to pay a premium for these products? For example, people are willing to pay $2,000 for a Louis Vuitton purse. There is perceived value there. And likewise, LVMH will never drop their prices on their luxury products. This company generates really high margins because, well, they charge a lot of money for the products that they sell, and people are willing to pay a premium for those products. Lululemon is another example and has one of the highest gross margins in the premium athletic wear space compared to their competitors like Under Armour and The Gap. People are willing to pay $100 for yoga pants, and so it's reflected in their gross margins. It's the highest in the space, which is sitting at around 56 to 57%. And lastly, one of the financial metrics to look at to determine if a stock is expensive is looking at their PEG ratio. This is the price to earnings ratio divided by their earnings growth rate. First off, price to earnings is mathematically just the current stock price divided by a company's earnings per share. It is a ratio used to measure the value of a company using its current stock price compared to its earnings per share. In other words, it's a metric to gauge how much people are willing to pay per $1 of earnings. It's a similar concept to housing. For example, take a house that's selling for $500,000 and it's a 1,000 square foot house. That means the house is selling for $500 per 1 square foot, $500 per square foot. For companies, we look at per dollar of earnings as opposed to per square footage. If a company's stock is trading at $110, its earning per share in 2022, for example, was $5, then its PE ratio, its price to earnings ratio, is 22 times. That means people are willing to pay $22 for each $1 of earnings the company generates. So what does 22 times mean? Is it expensive? Is it cheap? Well, let's say in 2023, its earnings is expected to be $7 per share. That means its earning per share growth from 2022 to 2023 is 40%. When we take the PE ratio of 22 and compare it to its growth rate of 40, that is just taking 22 dividing it by 40, we get 0.55. Now, as a general rule of thumb, when looking at the PEG ratio, a PEG equal to 1 means the stock is fairly valued. A PEG ratio less than 1, in this case, that means the stock is undervalued. A PEG ratio of greater than 1 means it's overvalued. This is how you're going to use a PEG ratio to determine whether a stock is fairly valued, undervalued, or overvalued. So you'll know when to buy a stock and when not to buy a stock. Now, of course, these are just some guidelines to follow. Just because a company's PEG is less than 1 doesn't mean it's a bargain and you're going to be making multiple times your money. Likewise, just because a company's PEG ratio is trading above 1 doesn't mean it's overvalued and a complete write-off and you should stay away from it. You have to look at all aspects of your research and make a decision based on all of your findings, not just any one single standalone metric or financial measure we just discussed. Because at the end of the day, when it comes down to valuation, these are based on assumptions going forward, the forecasted numbers, what is to be expected, and of course, they could be wrong. But that's the beauty of valuation, and that's what makes it kind of difficult to forecast how much a company will be worth. So it is very important to factor in all aspects, especially the qualitative aspects. So if you want to know what sorts of qualitative measures to look for, I have a cheat sheet for you. All you got to do is comment winning stocks below, and I'll hook you up with the link for that.